Imagine a machine so fast it can see your intent to buy or sell before your finger finishes pressing the key, and then act on that knowledge to take pennies off your trade, millions off your portfolio, and billions for itself. Imagine the stock market as a shimmering black box where ordinary investors click buy and think the market answers. But behind the curtain lives a new class of traders, engineered for speed, who live to exploit the tiniest timing advantage. This is not science fiction. This is how parts of Wall Street looked in the last decade, and the story of the men who saw it and decided to do something about it. Today's video walks through Flash Boys by Michael Lewis, a narrative investigation into high-frequency trading, HFT, the secret plumbing of U.S. stock markets, and the people who exposed it. We'll follow the key players, from the obsessive engineers who built ultra-straight fiber that shaved milliseconds off travel time, to a small team who realized the system was rigged against ordinary investors and set out to change it. We'll cover every chapter, preserve chapter accuracy, and end with the lessons that matter most for anyone who trades, invests, or cares about fairness in markets. Windows on the world. Michael Lewis starts by tracing the puzzle around Sergey Aleynikov, a Goldman Sachs programmer arrested for copying code. That arrest raised questions. What is high-frequency trading? Why is market-moving code so valuable? Lewis's curiosity leads him to a room full of people who understood a market transformed by computers, a market that no longer resembles shouting men in jackets, but invisible algorithms racing in server farms. The key idea: speed matters in ways people didn't appreciate. The new markets were run inside black boxes and were fundamentally opaque to ordinary investors. Chapter 1. Hidden in Plain Sight. What began as a simple idea slowly evolved into one of the most important and secretive engineering feats in modern finance. Dan Spivey, an entrepreneur with a knack for recognizing the value of speed in electronic markets, realized that in an age where machines traded faster than any human could blink, distance had become a form of currency. If one could shorten the physical miles between Chicago's futures markets and New Jersey stock exchanges, even by a little, the reward could be extraordinary. Spivey envisioned a fiber optic route so straight it ignored terrain, cost, and logic, cutting directly through mountains, forests, private land, and anything else that stood in its way. The purpose was not beauty or elegance. Its purpose was time. A few milliseconds gained meant millions of dollars captured before prices shifted. Spread Networks, the company behind the route, operated with absolute secrecy. Engineers were told almost nothing about the purpose behind their work. Landowners knew only that a mysterious, well-funded company wanted to bore holes under their property. Spivey himself rarely revealed the true strategy, that this cable, running like a laser beam across America, would allow high-frequency traders to spot and exploit price discrepancies between markets before anyone else could react. When the project was finally complete, the result wasn't merely a cable. It was a new kind of weapon. Those willing to pay extraordinary fees could buy access to this almost impossibly straight line, and with it, the ability to trade at speeds others could not hope to match. The entire financial landscape began shifting around this new infrastructure, though few even knew it existed. Chapter 2. Brad's Problem. While secret cables were being buried underground, Brad Kitsima sat at his desk at the Royal Bank of Canada, facing a mystery of his own. Brad was an anomaly on Wall Street, calm, polite, and genuinely committed to fairness. Yet every day, he faced a bizarre phenomenon. Whenever he tried to buy or sell shares, the prices that appeared available on his screen suddenly evaporated. Stocks he attempted to purchase at visible prices would jump higher the moment he clicked. Orders he tried to execute at displayed liquidity would simply vanish. At first, Brad wondered if he was simply unlucky. Then he wondered if there was a bug in RBC systems. But as the problem persisted, he sensed something deeper, something systemic. Large orders sent into the market appeared to alert invisible actors who reacted faster than humanly possible. It was as if someone could see him coming. As he dug deeper, Brad realized the markets were no longer a single marketplace, but a fragmented network of exchanges, dark pools, and internal trading engines. Each had different rules, fee structures, and hidden incentives. The old idea of trading fairly on a central exchange had quietly died. In its place existed a labyrinth that only insiders truly understood. He also noticed names like Getco, firms he had never heard of, dominating trading volume. It made no sense that unknown companies had suddenly become indispensable players. The more Brad searched, the clearer the picture became. Something in the market structure was enabling speed-based predators to exploit ordinary traders before their orders even arrived. This wasn't a glitch. It was a new ecosystem. Chapter 3, Ronan's Problem. If Brad understood the symptoms, Ronan Ryan understood the machinery that produced them. Ronan, an Irish-born telecom expert with a background in optimizing networks for Wall Street firms, knew better than anyone that the physical journey of an order was far more complex than traders realized. He explained to Brad that exchanges were no longer located in Manhattan trading floors, but in remote data centers scattered across New Jersey. Each center was separated by miles, and those miles translated into microseconds, an eternity for machines. Traders who understood this geography designed systems that exploited these micro-differences. Ronan described colocation, the ability for firms to place their computers directly beside exchange servers, allowing them to react faster than anyone connecting from outside. He explained how routing decisions, made inside broker systems, could unintentionally reveal information about large trades. And he showed that the moment Brad's orders left RBC's system, they took different routes to different exchanges, arriving at slightly different times. Those differences were enough. High-frequency traders could detect the arrival of the first part of Brad's order, infer the rest, then race ahead to buy the shares before Brad's remaining orders arrived, selling them back to him at a higher price. It wasn't magic. It was physics. For the first time, Brad realized that the market wasn't broken in an abstract sense. It was broken in a measurable, testable, mechanical sense. And with Ronan's guidance, he began piecing together how deeply the architecture itself had been weaponized. Chapter 4, Tracking the Predator. Brad and Ronan assembled a small group of trusted colleagues and began conducting experiments. They sent test orders, monitored the timing of routes, analyzed the responses of various exchanges, and reconstructed, step by step, how high-frequency traders were seeing and reacting to their activity. The closer they looked, the more unsettling the truth became. Ordinary institutional orders acted like beacons. When a mutual fund attempted to buy a large block of stock, the first small fragment of its order might hit an exchange in Mawa. Within microseconds, high-frequency machines in Carteret and Secaucus reacted, sweeping up shares across every exchange before the rest of the fund's order even arrived. The process was eerily predatory. A machine could essentially sense the presence of a large buyer or seller and maneuver to extract a tiny profit from the price adjustment that followed. It was like watching a school of piranhas react instantly to a single drop of blood. Through months of testing, the team reconstructed the logic of these systems. Some algorithms hunted for slow-moving orders. Some identified large traders and anticipated their next moves. Others exploited the fee structures of exchanges to earn rebates for providing liquidity while avoiding trades that carried risk. What unsettled Brad most was not that these strategies existed, but that the system had been built, intentionally or not, to allow them. Chapter 5. Putting a face on HFT. The high-frequency trading firms that dominated this new world were elusive, but not entirely invisible. As Lewis followed Brad's investigation, he introduced us to the people who ran these operations. Many had begun as traditional traders, but realized early that the future belonged not to instinct, but to algorithms. Inside firms like Tower Research, Getco, and others, the culture valued raw intellectual horsepower and engineering brilliance. Programmers who wrote microsecond-optimized code were the new rainmakers. Success wasn't measured by bull market calls, but by shaving nanoseconds off message processing time. These firms weren't uniform. Some genuinely aimed to provide liquidity and stabilize markets. Others focused purely on capturing fleeting price discrepancies, regardless of whether doing so harmed slower participants. To them, speed wasn't just an edge. It was the entire game. Lewis humanizes these characters. Competitive, intensely private, driven by puzzles rather than malice. Yet their innovations collectively created a market dynamic in which speed itself became the ultimate advantage, and every other participant, mutual funds, pension funds, retirees, became involuntary counterparties to machines. Chapter 6: How to Take Billions from Wall Street. As Brad's team dug deeper, they began to understand how exchanges themselves had evolved into partners in this new system. Maker-taker pricing, for example, rewarded firms that made liquidity by placing certain types of orders. High-frequency traders engineered strategies specifically to earn these rebates, sometimes prioritizing fee capture over actual economic value. Internalizers, large banks trading against their own clients' orders, further complicated the picture. They often sold their order flow to high-speed firms, allowing those firms to see trades before they reached public exchanges. And then there were the custom order types, obscure, technically complex instructions available only to sophisticated players, allowing them to hide intentions, jump queues, or step ahead of slower investors. Each small edge was minor in isolation, but multiplied thousands of times per second. Across billions of shares, the profits became staggering. The financial system had become a battlefield of timing sensitivities and engineered incentives, one where the fastest always won. Chapter 7: An Army of One. Faced with the scale of the problem, Brad made a decision that surprised even himself. If the market was engineered to disadvantage ordinary investors, perhaps the only solution was to build a new one from scratch. With Ronan and a core team, he set out to design an exchange that neutralized the advantage of raw speed. IEX, the Investors' Exchange, began with a radical principle. Fairness was not the absence of technology, but the intentional design of it. To achieve this, they embedded a speed bump, a 350 microsecond delay, into every order entering the exchange. It wasn't symbolic. It was a direct countermeasure to high-frequency predation. The delay made it impossible for fast traders to detect a large order and race ahead of it. They redesigned routing logic so that the exchange could not be gamed. They refused payments for order flow, eliminating conflicts of interest. Every piece of infrastructure was engineered to protect the investor, not the algorithm. The process was exhausting and often demoralizing. They were a small group battling a system backed by billions. But the mission gave them clarity. If no one else would protect fairness, they would. Chapter 8: The Spider and the Fly. As IEX took shape, resistance intensified. Established exchanges saw the new model as a threat to their business. High-frequency firms saw a threat to their profits. Large banks were torn between supporting fairness and preserving the lucrative relationships they had built with speed-based traders. Lobbyists mobilized. Critics argued that IEX's speed bump distorted markets. Competitors questioned its legitimacy. But slowly, evidence accumulated. Investors who had been losing money unknowingly through predatory routing saw better execution on IEX. Mutual funds respected the transparency. Smaller brokers began routing trades there. Still, the political battle was fierce. The metaphor Lewis uses, spider and fly, captures the dynamic vividly. The spiders, with webs spun out of complexity and secrecy, had thrived in the old system. IEX was essentially tearing down the web. Despite the opposition, momentum grew. The more people understood how the system had been tilted, the more they rallied behind IEX's mission. What began as a technical challenge evolved into a philosophical one. Should markets serve the fastest traders or the fairest rules? Epilogue: Riding the Wall Street Trail. Lewis wraps up by reflecting on institutions, incentives, and human agency. Technology doesn't automatically improve markets. It amplifies existing incentives. When incentives skew towards speed and secrecy, markets become engineered to harvest small advantages and hide the process from participants. But people like Brad and the IEX team show change is possible. By designing markets with investor protection in mind, structural unfairness can be mitigated. Lewis also points to unresolved questions. Who did regulators serve? Why did incumbent institutions ignore or profit from the distortions? And how do we preserve markets that allocate capital efficiently while being fair to those who rely on them? The big lessons. Market structure matters. The shape of exchanges, routing rules, and fee schedules determines winners and losers more than most investors realize. Speed is a commodity. When milliseconds and microseconds can be monetized, physical infrastructure, fiber routes, colocation, becomes financial leverage. Opacity breeds exploitation. When systems are too complex or opaque for users and watchdogs to understand, profit-seeking actors will exploit the gaps. Ethics and engineering can align. IEX demonstrates engineers and traders can intentionally design systems that curb predatory behavior without destroying efficiency. Regulation and vigilance matter. Markets evolve faster than rules. Continuous oversight is required to ensure fairness. If you invest, whether through a broker, retirement fund, or DIY platform, the details of market structure affect your returns. Understand that trades aren't simply matched magically. They pass through layers of rules and technology that can capture value. Favor brokers and funds that prioritize transparent execution practices, and remember, the battle for a fair market is ongoing. If you enjoyed this breakdown of Flash Boys, leave a comment about which chapter surprised you most, and subscribe for more chapter-accurate summaries. Thanks for watching. That's the story of Flash Boys, speed, secrecy, and a small group of people who try to make markets fairer. For the full sources and rich detail, read Michael Lewis's book. See you in the next summary.